Now, in this segment, we're going to pivot a bit into the consumer because we have some of the leading indicators that are good for manufacturing, but also consumption, especially when we look at where things are in general from the view of retail sales. So December Philly Fed, the index was expected to be at -10, came in at -13.8. New orders sank further into contraction. And remember, new orders is a very key leading indicator. Prices move down, but are still expanding. And again, that's the rate of change that we continue to see where, yes, our price increase is slowing. Yes, the rate of change is slowing, but they're still going up. And that is the key piece of why the Fed is looking at this saying, well, they're still going higher. It isn't like they've crested and started coming down. Prices are still going up. The comps versus last year are easier, but you still have a lot of this sitting in the market, which is a problem. Then when you look at delivery time sank, which is good. Average work week now firmly in contraction with employment falling to the lowest since 2020. None of that is good. And a lot of that are good leading indicators for PMI in December. So again, you're already seeing that things have gotten worse on a lot of different levels. December Empire Manufacturing Index was expected to be at -1, came in at -11.2. New orders still in contraction. Prices moved up. Again, new orders still slowing and prices moved higher. Work week popped back into expansion and the shipments dip, but are still expanding. Employment rose to the highest since July. So employment was a good thing, but prices moving up. So now you either have prices coming down but still expanding, or prices actually moving back into expansion, which is the underlying issue that we've talked about with inflation, because it's not going anywhere. And that's where you get a lot of this back and forth. And I think, to be fair, and for those that know me, I have not been a fan of Jeremy Powell, but I actually think he has a good trend going and is doing the right thing at this point, as long as he continues up, as long as he stays a bit longer. And I think that'll be a very important piece. November retail sales came in at -0.6. The estimate was to be -0.2. When you look at the prior month, it was up 1.3%. But again, you're starting to see that come back down. Sales ex autos expected to be up 0.1%, came in -0.2. Control group came in at -0.2 versus the estimate of 0.1. Now, this is not even adjusted for inflation. So things are getting worse. You're getting, the prior month was revised down. It was at 0.7, came in at 0.5. So again, we thought October was going to be the month that you saw this big drop. We were wrong, but it was November. And one of the things that we're looking at is this is only going to accelerate to the downside as you see that in December, as you see that as we go into January and beyond. So now when we look at negative payroll revisions, and the question is, what is really happening in the world of the unemployment? So payroll revisions, final versus first estimate, survey response rate. So as the response rate goes down, typically that means that you'll get a negative payroll revision because the payroll survey is undercounting what is happening because there's a certain level that they need, and then they extrapolate, which is showing that that maybe things aren't as good as they appear in the unemployment world, in what is happening in the jobs market. But it still doesn't mean that we're at 4.5% unemployment. It just means that we're maybe closer to 4.1%, still below the natural rate. Outflow of workers from employment into retirement is one of those big issues, because if you look at not in the labor force, this is the labor force participation rate shift that we're seeing, is less of these individuals are going from I'm unemployed. They're like, look, I'm just retired. Like, I'm done with this. It's over. And that is reducing a lot of those people in the labor markets. Then when we look at US PPI, so consumer foods component of PPI, inflation jumped by 3.7% in November, fastest increase since May 2020, and before that since 1974. PPI is accelerating again in November, which is creating this, okay, well, Where's inflation going to be? Because remember, PPI is leading to CPI. So PPI in November is going to show up as an acceleration in December, January, maybe February, but it should really be December or January, which is going to be a concern. And again, all the more reason why the consumer's still going to get hit and the Fed's still going to have to keep raising rates at their level. Economic strength in terms of economic surprises. When you look at confidence, the strength of data relative to 1 year average, housing orange is by far the worst segment of the economy right now. And housing is a great leading indicator. Industrial is starting to roll over a bit. Retail bumping along the bottom. We see that cresting and coming down because we think housing is really that leading indicator that's going to show us where things are headed. U.S. household net worth fell by $392 billion, much less severe than the $6.3 trillion drop in last quarter, but you're still seeing that contraction, and that is going to be a bigger issue because, again, people will take in that money, and as that money is coming in, as we saw in 2020, 2021, people will spend it. But once it's in your bank account and you see your net worth dwindling, even though that savings is there and it's more than what it used to be, are you going to be in any hurry to spend that? What is the impetus to drive you to the market, given where the market is heading, given where jobs are, expectations are? Shouldn't I keep that for a rainy day? Is that going to pay my mortgage or my rent for 6 months? And that's where I think this savings number continues to get inflated. One thing, a lot of people now talk about the savings number as a lump sum. Well, it's not a lump sum. People have different levels of savings. So the lower 80% of Americans don't have that savings anymore. It's gone. So to say that, there's still excess savings. Yeah, in the top 10%, those people don't need to spend it. And if they look at where things are, why would you spend it? Let's just save it. Maybe we'll invest it somewhere. And that's where you see some of those slowdowns. Now, the relative price of CPI core goods to CPI core services is adjusting, but as we've been saying, core services is more on the sticky side, as we showed in segment 2. So now when we turn to, as we talked about with PPI going into CPI, and then the core versus service and goods, we have to look at, what's happening with CPI right now? Well, the improvements for November, the headline came in at 0.1, the estimate was for 0.3. Core was expected at 0.3, came in at 0.2. So you're still seeing an increase. It's not at the same rate of change. Again, that disinflation. It's just the inflation isn't increasing to the same degree. But one of the things that we've been very adamant about is that we're not going to see a steady decline of that inflation into deflation. The rate of change is still going to be positive. Just is it going to be 0.1, 0.2, maybe flat for a month? And then reaccelerate. And as we showed, PPI actually went up again. Small businesses still raising prices. We're still getting price increases, which is going to essentially filter down to this key metric, which is why when we look at it, it's not getting any better, which is also going to keep the Fed active. It's going to keep the Fed moving forward. Now, November CPI year over year is expected to be at 7.3, came in at 7.1. Core was expected to be at 6.1, came in at 6. But look at where we are. Look at how elevated we are. And yes, year over year, comps are much easier. But it doesn't mean that a month over month basis, people like you and I aren't going to get hit because our prices month on month are still going up. Sure, they're not going up as fast as they were in 2021, but it doesn't mean that they're still not rising. And that is a big component when we look at what is going to happen going forward. Now, when you look at U.S. core services CPI, month on month came in at 0.4. Core services CPI year over year, 6.8. So services is still going up at a very healthy clip. When you look going back to 2016, we're still at a high end for services. And as we've been saying, service price increases are sticky. That is not something that quickly adjusts itself. It's still going up, and even on a year over year basis. U.S. core CPI, as we showed, 6.1% versus 6. You're still elevated. You're kind of just hanging out at this top. And based on where PPI is, based on where median is, where 16% trimmed is, there's a lot of staying power in these levels. Now, the breakdown in CPI by components, here you can see just in general, the slowdown energy was the biggest driver of that reduction. But that also goes away. That comp gets easier as well as it comes down, but you still have core services, very extended. You have core goods coming down, but still high. Food, still very much a problem and getting worse based on the PPI for the food data that we showed. Core goods, blue labeled commodities per CPI's language, is in meaningful disinflation. Core services perhaps finally peaking, but even as it peaks, we don't see it dropping. And when you look at it, and again, that disinflation it's still expanding, just at a slower rate of change. So that's where it's still inflation. It's still going up and hitting us. It's just the rate of change has slowed. Looking at the trend for owner's equivalent rent, a 3-month annualized change is still at a 8.8%, but the view is that we're going to peak soon and it'll slow down, but it's still going to increase underlying prices. 3-month annualized change in food component, CPI fell to 7.8%, but still at 7.8% when you analyze it, but still hot relative to history, but down considerably from the peak of 13.9%. So 3-month annualized, it's coming down, but when you look at that blue line, it's still going up. It's starting to crest and flatline at the top, while owner's equivalent rent component of CPI is still up 7.1% year on year. So these are the two things that hit people the hardest, because you're paying your rent every month, your mortgage every month, and you're buying food every day, every week, however much you go to the grocery store. So again, a lot of this upward trajectories. Compensation component for the small business update fell to the lowest since July 2021. Plans to raise compensation also declined, but have been in more of a range this year, which is going to be the case. Like when you look at that orange line, plans for compensation, it's come back, but going back to 1985, we're still at one of the highest we've ever been. Compensation index coming down, still the highest since 1984. All of this is just, again, keeping things elevated. No major moves for small businesses seeing higher prices or planning to hike prices in the next 3 months, which is that orange line. If any, the latter has rebounded of late and stabilized at a very elevated level, which is why we still see those increases. So then when we look at an unwind of labor tightness, job openings hard to fill, which is the blue, and hiring plans, orange, components continue to roll over in November. So again, more of a trajectory of that drop in just jobs and where things are on the employment side. Real average weekly earnings still negative, but trending up. They're still down 3% year on year in November, which was the best since February. But again, the people are still making less money. So people are still losing money because of inflation, and inflation isn't slowing, but wages are starting to pause, slow down a bit, and that is becoming a bigger issue. With the rent index rose by 0.06, slowest increase since June 2020, but there's only so much pace you can maintain, and are we going to start to actually get deflation in some of those rent prices? November small business optimism index bounced up to 91.9 versus 90.5 estimate. Outlook turned lower, and plans to increase inventory dipped into negative territory. CapEx expectations nudged up a bit, but inherently we're at levels that we haven't been at since the COVID crisis started and the great financial crisis. So then when you look at PPI, as we were saying before, survey was for 0.2, actual came in at 0.3. Core PPI, survey was for 0.2, came in at 0.4. We got a reacceleration. Again, the rate of change increased, which is going to drill down into CPI. We're going to see that pressure as we've been talking about. November PPI, again, came in at 0.3 versus estimate of 0.2. Core 0.4 versus 0.2. Notable that trend for core was moving down from August through October, but reversed higher. And this is what we've been saying. We expect to see a flatlining, and just the rate of change is going to slow, but it's still going to be positive. We're not getting deflation. We're getting the rate of change slowdown. So then when we start looking at service component within PPI final demand, inflation increased in November, but 3-month annualized change has eased, but we're still getting that final demand moving up. November PPI was expected to be at 7.2, came in at 7.4. Core was expected to be at 5.9, came in at 6.2. All of this, and then the others were revised higher. So we're getting, yes, it's coming down. Year over year comps are harder, but it's still moving in the wrong direction. We're not coming down as fast as people want, as fast as the market expects, which is an underlying problem that we've been highlighting. November industrial production came in at negative 0.2 versus the estimate of 0. So again, starting to start that rollover as we saw the flatlining, and now we see a steeper drop coming up. Small business optimism, as we were saying, earnings changes, bounced but still negative. Small business sales expectations still see slowing activity. Inventory accumulation came into negative 4. Again, not looking to add any type of new inventory. Small business compensation index still positive, still growing, just at a slower rate, which is, again, a tailwind to some of that inflation, but it's going to put pressure on wages because they're not going to move at the same rate. It's going to slow. Compensation plans coming back still at the highs. Again, all of these things are going to be more of that backstop. We need to see this meaningfully drop, and then we'll start to see some of those prices come down because companies need to pass on some of this somewhere. Small business job openings, hard to fill, declining. And then when you look at JOLTS versus that, you start to see that they're rolling down a bit. So you're going to see JOLTS come down. You're going to see some of those jobs. You're going to see unemployment increase a bit, which is something that the Fed is actually looking for. Pace of wage growth reaccelerated in November for job switchers and job stayers. And that's, again, that reacceleration, more of that tailwind, more keeping things elevated. Wage growth taking longer to recede. Tracker update in November, again, still staying at these levels. They've come down, but when we looked at Philly Fed, when we looked at Empire Manufacturing, you had prices still elevated. You still have a lot of that staying power. This is going to go into PPI. This is going to keep CPI going up, and why we continue to see these pressures around the U.S. Wage growth remains strong for lowest earning quartile. We don't see that changing, but pace of growth continues to accelerate for highest earners, now at fastest since 2001. As that accelerates, you need to recoup that cost. It's still below the pace of inflation, so wages are still negative, and this is where you start to get into the bubble of, are we going to get a wage spiral? And that's why the Fed is going to continue upwards. It's going to continue to drive higher a lot of these different pieces. Then when we look at December University of Michigan consumer sentiment, expected to be at 57, came in at 59.1. Current conditions expected at 58.8, came in at 60.2. Expectations. So things are not as bad as they were, but you can still see we're bumping along the bottom. Here, recessionary-like move in consumer expectations for higher unemployment next year. And this is when people are looking at next year and saying, well, I have this savings. Do I spend? I see the pain coming. Why am I going to go out and blast all of these savings when I might need it? Because unemployment is a concern. And that's where we're going to continue to see some of these pivots. Looking at the regional breakdown for owner's equivalent rent within CPI, you can see that they all continued higher year-over-year gains, while Northeast is seeing the slowest climb, but it started from the highest. So again, that's where we're going to continue to see some of those moves. New home sales during a tightening cycle, you can see that we're right around where we were in 1980. So you're going to continue to see that slowdown. Year-over-year home appreciation, they project year-over-year price changes of negative 10 to negative 15% by year-end 2023. So again, that deceleration, which will be a positive for CPI in terms of home owners equivalent rent, but people that already purchased homes at 16.7% are going to be underwater. So you paid in additional. Now, if you had to sell, you're not getting that equity back out. You're going to be underwater, which is why we call them golden handcuffs. Yes, you're underwater on an equity standpoint, but you're underwater with a mortgage of 2.5%. So you can still finance your mortgage. You just can't sell your home because you'll never pay back that until you pay down that equity in order to get back in the green or the black. University of Michigan median expected percent increase in household income in 1 year. Expected to go percent increase in household, that's a net positive. U.S. wage trackers versus quits. You're continuing to see the quit rate start to slow just because you're like, well, jobs are getting a little bit harder, not as plentiful, and that's when you start to see that slowdown. That's more of a leading indicator for some of the jobs data. So that's what we have for you today on the U.S. In the next segment, we're going to go deeper into Europe and how some of the things have started to slow down again as we go into year end.